Now we're going to look at the main profitability ratios. And the first one under that is the gross profit ratio, which is equal to gross profit upon net sales into 100. Now, as far as gross profit is concerned, you directly have a formula where gross profit is equal to sales, okay, minus cost of goods sold. Okay, and cost of goods sold in turn, cost of goods sold is equal to opening inventory plus purchases minus closing stock. Right, so you know how to get gross profit and gross profit ratio. Please remember, we are starting with sales. Sales minus cost of goods sold gives you gross profit, minus operating expenses gives you operating profit, and then by adding non-operating income and subtracting non-operating expenses, we get ourselves net profit. Okay, and I'm just going to write net profit before interest and tax. Then we subtract interest, we get net profit before tax, we subtract tax, we get net profit after tax. Now, corresponding to this, we have something called the operating profit ratio, which is equal to operating profit. Okay, and I'm just going to use short forms: operating profit upon net sales into 100. Similarly, the net profit ratio is equal to a net profit upon your net sales into 100. Apart from these, you also have certain profitability ratios that deals with returns. Okay, so we have ROCE, which is return on capital employed, which is equal to earnings before interest and tax, okay, which we can also call net profit before interest and tax. Okay, we have one and the same. Earnings before interest and tax. Okay, so earnings before interest and tax upon what is called capital employed. Now the capital employed formula is equal to equity share capital. Oh, before we get into that, okay, it is equal to owned funds plus borrowed funds, but long term. Okay, so when we talk about owned funds, we mean equity share capital plus reserves and surplus. For borrowed funds, we mean long-term loans and debentures. Okay, so keep that in mind. Then we have return on equity, ROE, which is return on equity, which is your earnings available to equity shareholders upon proprietors of shareholders fund, or simply equity share capital plus reserves and surplus. Alright, so keep in mind, once you have net profit after tax, you can subtract preference dividend and get yourself earnings available to equity shareholders. Okay, so we're done with these formulae. Thank you.